What happens when two massive exchanges coordinate an attack and think nobody's watching? The gold and silver massacre just exposed the playbook. Banks made $2 billion. Retail investors lost everything. And the timing was so precise, it's impossible to call it random. I've traced the entire operation, from margin hikes to short positions to historical patterns that prove this has happened before. Subscribe and turn on notifications so you never miss these investigations. Drop a like to fight the algorithm, because what I'm about to show you reveals the exact moment they pulled the trigger and who knew it was coming. The timing was impossible to ignore. CME Group raised gold margin requirements on a Monday. Shanghai Gold Exchange did the same within 16 hours. 2 exchanges, 2 continents, 1 synchronized strike. Margin requirements work like security deposits. When exchanges raise them suddenly, traders must add more cash immediately. Those who cannot pay face force selling. Their positions get liquidated automatically. This is exactly what happened. Billions in long positions were crushed overnight. Traders describe it like pulling a rug from under someone mid-step. The fall was instant and brutal. Here is the red flag. These coordinated margin hikes last occurred in September 2011, right before silver crashed 40% in weeks. The pattern is resurfacing. Why would 2 competing exchanges, often at odds, move together with such precision? Who benefits when leveraged buyers are systematically destroyed at the worst possible moment? The answer requires following the money trail deeper. The synchronized margin strike was only the first domino. The crash followed a textbook pattern. Gold had just broken above key resistance at $2,400. Technical traders call this a breakout moment. Historically, breakouts attract massive buying pressure. But something strange happened instead. Within hours of the breakout, enormous sell orders flooded futures markets. The timing was surgical. Sellers targeted the thinnest liquidity windows, specifically Asian overnight sessions when fewer buyers exist. Think of it like ambushing someone in a dark alley versus a crowded street. Maximum damage, minimum resistance. The anomaly becomes clearer examining trade size. Normal institutional selling spreads across hours or days. The selling concentrated into minutes. Flash crash signatures appeared on multiple charts simultaneously. In 1980, regulators used identical timing strategies against the Hunt brothers. Massive sell orders during low liquidity windows. The playbook never changed. Was this organic profit-taking? The data suggests otherwise. Breakout moments typically trigger buying, not coordinated selling from multiple major players within minutes. History repeats with disturbing precision. In 1980, the Hunt brothers controlled nearly 1/3 of global silver supply. They were systematically destroyed when exchanges suddenly changed rules mid-game. COMEX introduced position limits and raised margins 5 times in 1 week. Silver collapsed from $50 to $11. The 2011 silver massacre followed identical steps. Silver approached $50 again. CME raised margins 5 times in 9 days. Price crashed 44% within weeks. The current attack uses the same weapons. Margin increases, rule changes, coordinated timing. It resembles a boxing match where the referee suddenly ties one fighter's hands. Each historical suppression occurred when metals threatened specific price ceilings. $50 for silver, $2,400 for gold. These levels appear to trigger institutional panic. What makes these ceilings so dangerous to defend? Why do authorities treat these specific prices like red lines that must never be crossed? The pattern suggests something valuable lies beyond these barriers. Shanghai was supposed to change everything. When China launched its gold exchange, analysts predicted it would break Western price control. Eastern physical demand would finally set fair prices. That was the promise. The reality proved different. Shanghai has become a willing partner in suppression operations. Their margin hikes now coordinate with COMEX like dance partners following the same music. Consider the irony. China publicly criticizes dollar dominance while privately helping suppress gold prices. This contradiction reveals deeper arrangements invisible to ordinary investors. Think of it like rival corporations publicly competing while secretly fixing prices together. The appearance of competition masks hidden cooperation. The historical parallel dates to 1975 when London and New York coordinated gold sales to crush prices after America ended dollar-gold convertibility. Different era, same strategy, different exchanges, identical results. Why would China cooperate with Western suppression schemes? What does Beijing gain from artificially low gold prices? The answer may involve massive ongoing accumulation at discount prices. Paper and physical markets are splitting apart. COMEX trades paper contracts representing gold that may not fully exist. For every physical ounce, over 100 paper claims trade daily. This leverage creates fragility. During the recent attack, paper prices crashed. But physical dealers responded strangely. Premiums on coins and bars actually increased. Delivery times extended from days to weeks. The paper price said gold was cheaper. Reality said the opposite. Imagine a grocery store advertising bread at $1 while actual loaves cost $5 and require 3-week waits. The advertised price becomes meaningless. In 2020, a similar fracture emerged during pandemic chaos. Paper gold traded $80 below physical prices temporarily. The system nearly broke before emergency interventions restored order. The current disconnect grows wider with each coordinated attack. Physical buyers increasingly distrust paper prices completely. Coin shops report record demand precisely when futures show weakness. How long can two contradictory price systems coexist? When does this fracture become an irreparable break? The fingerprints are visible in COMEX positioning data. 2 weeks before the crash, commercial banks added record short positions. These are bets against gold prices rising. The timing was perfect, almost prophetic. Commitment of traders' reports showed something unusual. 8 major banks controlled 70% of all short positions. This concentration level typically signals coordinated action, not random market behavior. Think of it like 8 people suddenly buying fire insurance on the same building days before it burns. Coincidence becomes impossible. JP Morgan's trading desk particularly stands out. They covered massive shorts during the crash, booking profits estimated near $2 billion. Other banks showed identical patterns: short heavily, wait for crash, cover positions, repeat cycle. The 2008 financial crisis revealed similar positioning before Bear Stearns collapsed. Insiders always position themselves before major market events. Knowledge equals profit. Small investors held record long positions just before destruction arrived. They walked directly into an ambush while institutions positioned perfectly for the massacre. The evidence points toward desperation. Coordinated attacks require extreme effort and risk exposure. Authorities only deploy such tactics when threats become existential. Gold and silver represent alternatives to fiat currency systems. When metals rise, faith in paper money falls. Central banks cannot allow this psychological shift, especially now. Global debt exceeds $300 trillion. Interest rates remain artificially suppressed. Currency debasement accelerates worldwide. The system survives on confidence alone, rising precious metals. Prices broadcast danger signals authorities must silence. The attacks will intensify. Each intervention requires more force than the previous one. Like drug tolerance, market manipulation loses effectiveness over time. Eventually, the medicine stops working entirely. Physical metal continues disappearing into private vaults across Asia and Europe. Paper games cannot manufacture actual gold. Mathematical reality always wins eventually. The next attack may already be planned. Watch for margin increases during thin holiday trading. Monitor Shanghai COMEX coordination patterns. The playbook remains unchanged, but its effectiveness weakens with each desperate application. The synchronized CME Shanghai attack exposed a critical truth. The precious metal suppression system requires increasingly desperate coordination to function. 2-continent margin strikes, surgical timing during breakouts, historical playbook repetition. These are symptoms of a control mechanism under extreme stress. The evidence trail reveals institutional foreknowledge, coordinated positioning, and systematic retail investor destruction. Physical paper price fractures widen with each intervention. China's transformation from disruptor to collaborator suggests deeper arrangements than markets understand. What comes next follows historical precedent. More aggressive attacks during thinner trading windows. Sudden rule changes favoring short positions. Media campaigns questioning metals, ownership legitimacy. But mathematics remains undefeated. Paper claims exceeding physical reality by 100 to 1 cannot persist indefinitely. The next breakout attempt approaches. Institutions are already positioning. The question is not whether the suppression system breaks, but when the breaking point arrives. Watch Shanghai's overnight sessions. Monitor COMEX margin requirements. The pattern will repeat until it finally cannot.